What's up, guys? It's JDew and Jonah, the banking bros of the Cash Compound, here to give you another great topic and an episode to cover what we help people do, save and spend money at the exact same time. I'm glad to be back right now. It's August 2021 right now, and we have kind of been on hiatus for a little while.
Yeah, we took a little break from podcasting, not from anything else, but from getting in front of the microphone and the camera and talking to you guys. So we're happy to be back, and I think we've got an interesting topic for the day.
We do. We're just going to cover some of the things that we have been going over for this last summer with actual customers and clients, people who ask us questions, get into the DMs. So we've got one to get us back in the mood, and it's all about our frequently asked questions.
Yeah, so we're going to walk through frequently asked questions, some of the things that we've gotten over the last few months or the last few years, give you some answers, give you our insight into them, and have some fun with it. So
let's jump right in.
Yep.
All right, Jonah, hey, it is August, beginning of August 2021. We've been working hard. We've actually had some new successes in our business. We're expanding very soon to be able to help the Hispanic and Spanish-speaking market with some of the things that we do. And we've added some team members and cool stuff like that. So let's now talk about those frequently asked questions, things that people hear and see on the internet all around, and it gets them confused and kind of backward on some things. I'm going to pose a couple of these facts to you, and I want you to answer them.
Sure.
Okay, so question number one, things that people ask us is, when it comes to banking, how much money does it take for us to start this process? I see what you guys are doing. I'm Googling stuff here and left and right and up and down. Like, how do I get started?
Sure. That's a good question. So I feel that question. I think the phrase is, I feel that on a spiritual level, right? I feel that question because when I started, I definitely kind of thought that, right? Like, the people who are introducing me to this, the people who I know are practicing this, maybe make a lot more than I make or have a lot more than I have. So do I even qualify to do this?
Yeah.
Right. And so I felt that, right? And then you hear things like, oh, because I've been practicing banking, I've done, and they list all these crazy cool things.
And crazy cool means that I ain't got the money to pull that off.
Yeah, like I own a plane and I bought 3 houses and I put a whole wing on my church and got all the money back, you know what I mean? And it's
crazy
like,
stuff.
I just going and giving an offering, pray, like the average person.
I'm out here like Justin Bieber. What do you mean? Like, I can't do any of that stuff.
Yeah. So I feel that question, but the reality is, and the same answer that we got 5 or 6 years ago, right, when we started, was you can actually get started with pretty much anything that you want to put into the policy. Now, there are some stipulations about who the insured is on the policy when you're talking about a specific dollar amount. But I mean, I've helped people get started with, $100 a month.
Right.
If that's what they had. And there's really you're not going to hear it from us saying, oh, that's not enough, or you got to do more. I mean, because we just don't operate like that. You can get started with whatever you've got. That's the way that I got started way back when.
Yeah.
I think I did $5,000 to get started all year because that's what I had.
Okay. Yeah.
Right?
Yeah.
Well, that's how I got started. And then we built it from there. So
help everybody understand right here. If you're listening, they're listening to us for one of the first times, is when you said the insured person, it depends on them a little bit. Like, what does that mean? Who's the insured person?
Yeah. So the insured person is the person who is the death benefit is going to pay out upon their demise, upon their death.
Okay.
And so, for instance, you can own a policy on an insured that's maybe a family member or a business partner or something like that. So I've got a policy on my 3-year-old son, right? So he's the insured. Something happens to him, the insurance.
Yeah, and you own it, obviously.
Family, right?
So I tell people sometimes, like, I own, when the kids come over to the house in the neighborhood, and then my kids get ornery and mean, they say, hey, get off our lawn, get off our property. Remember, kids used to say that when you were a kid.
Sure.
It's like, it's not really theirs. It's mine. It's dad's. You're 3. You don't own it. So the insured person is the child,
And then
but
the owner
I'm the owner.
Ours.
Yeah.
Us.
So you're saying it depends on them, meaning it depends on their age.
Yeah. If they're under 18,
yeah,
that's when we can really get you a policy going for maybe some of the smaller dollar amounts, so to speak. When you're over 18, normally you've got to do a tad, little bit of a bigger dollar amount.
Right.
And when I say a tad bigger, I do just mean a tad, like, $2,000 all year, $3,000 all year, $4,000.
Sometimes that's small.
Yeah.
Right.
But you just can't get away with $1,000 all year when you're over 18.
When you become an adult.
Yeah. And again, that's some underwriting stipulations, some requirements in there that's not super important for us to go through, but that's just what I mean. So just because you might not, you could be 50 and then I don't have $10,000 or whatever. That doesn't mean you can't get started. Right. And so we've helped lots of people get started, with what they have. So.
Yep. We'll walk you through that anytime you want to know. Question number 2, Jonah, is there's a lot of confusion out there about whose money we're borrowing, depending on who you're talking to. So here's the question. It's, am I borrowing my money? Am I borrowing someone else's money?
Sure.
Why is it called borrowing?
Yeah, that's a good question. So there's actually even a very, very popular financial expert and guru out there who recently had an interview and said it the incorrect way. And then actually went off on a pretty much tangent about it after he said it and thought about it the wrong way, never fixed it at all. So the answer to the question is, when you take money out of the cash value of these whole life insurance policies that are set up for banking, the way that we set them up, you are not taking out your own money. So I like to explain it to people like this, keep it nice and simple. When you go to the bank, your local bank down the street, and you go to the ATM or you walk inside, you're doing a withdrawal, and a withdrawal is going to be of your own money.
Right. So your account goes down.
Right. The reason that you'll hear us, again, and it's whatever book you're reading, YouTube video you're watching, podcast you're listening to, the reason you hear us say things like borrow and loans is because it's not your money. Right. And as a big, that simple kind of phrase is like a huge distinction. A lot of people don't get that. Right.
Yeah.
They say things like, oh, I put in this dollar amount and I could only take out this much. Where's the other money going? How much is left? And they're just under the mindset that you just did a withdrawal, and you just didn't do a withdrawal.
Correct.
You borrowed, you took a loan from it.
So sometimes we show people the 3-cup scenario.
Sure.
If I had them right here, I'd pull them out for those of you who are watching, and your money's going in a cup.
Cup 1 or premium.
Right. Deposit cup. And cup 2
is cash value.
So when you take that, and who put the money in the cash value cup?
Insurance company did.
Yeah. So it's not yours.
Not the same cup, not the same bucket, not the same pool, whatever you want to look at. So it's a very frequently asked question, but it's actually a relatively simple answer. Well, the reason that it's called a borrow, it's called a loan. The reason we talk about practicing banking and maybe paying that loan back is because it's not your money that you just took out, which is a very, very, very good thing as well. A lot of times I might say that and people go, oh, do I want to take someone else's money? Because up to this point in their life, every time they take someone else's money, it's not a good thing. But inside these policies, it's a great thing. What I like to make sure that you're understanding is if you took $100 in your bank account and then you withdrew 90 of it, you've only got 10 left.
Right.
So if you're earning any interest, if you're getting any bonuses, dividends, if anything cool's happening on $100, not anymore, you've only got 10 left. Whereas what we do, you put $100 in your banking policy, and even though you can take a cash value loan, you've still got the $100 in there.
Yes, it went into a different cup, right? Different bucket.
Deal.
And you control the whole system.
Yeah.
Which is obviously not the same way when you borrow third party.
Yeah, huge deal. I pointed out to someone the other day, I said, imagine how much money you would have had if ever since you started working at 18, it went into one cup, one pool, one bucket where you were going to earn interest off of it, get dividends paid to it, and you never took any of it out. Not saying you wasted your money, but you never had to take any of it out to buy groceries, to pay for gas.
How much money would that be?
How much money would you have? How would it, much would it grown to, right?
And how great these policies are is that you have a credit account basically in cup 2, bucket 2, based on what you've started since you're 18 and everything has gone in there. So you've actually never disrupted the power of the growth.
And I think it's important to tell people, I'm not saying that you're wasting your money. I'm saying you had to buy groceries, you had to buy cars, you had to get gas. I'm not saying you didn't have to do that. I'm saying you used the wrong money to do it the whole time. Right? That's why you don't have any left over. That's why it's not earning. because you had to spend yours to do all that stuff. Well, now we're teaching you not to do that anymore. So,
all right. We ask people from time to time to imagine compounded growth. I just mentioned that. But their question is, hold on, so what's that rate of growth? What's the rate of return? Potentially, can't I go get more return elsewhere?
Sure. So rephrase the question for me one more time.
So the question is, can't I get a higher rate of return in other places? Because you said there's a growth rate. What is the growth rate? And, well, what if I can get higher somewhere else? Isn't that better?
Sure. It's a very good question. It happens all the time. I get asked that question all the time. Here's the issue. Well, there's a couple issues, problems with that line of thinking, just to be specific. The first thing is, yeah, absolutely. I mean, I've heard of things that can give you, higher interest, 10, 12, 15, 20. I've heard of all those things before. I know some of them, right? And so the problem is, though, if you put your money there, the money, generally speaking, probably 9 times out of 10, if not 10 times out of 10, is going to be locked there, which means you might be earning a bunch, but only if the money sits there. You can't actually use it, which again goes back to well, then what money are you going to use for gas and groceries, right? You still have to give up some of yours.
Right.
And again, we're just teaching the opposite. Like, while your money's earning, go ahead and use someone else's to still buy the things you need, right? And so that line of thinking doesn't combat that, or doesn't kind of parallel with that question very well.
Because it's an apples and oranges scenario. Yeah. Because people think or assume when they see a presentation from us, watch our videos, call us, at the outset, you're not ever realizing that you're not using your dollars to buy your gas and groceries. You're using this banking policy, cash value available credit account, the word I just made up here, for your actual expenses.
Right.
So if you did not have that option, which you've never had previously, it's a relevant question. Well, if I can get 4% here or 10% here or 2% here or 5% here, well, sure, I'd go with the bigger number 2.
Right. And the thing that you've got to understand as well is that this situation that we're talking about actually invokes being able to still go get those higher percentages. We just teach you to use the cash value to go get those higher percentages, right?
Yes.
So while you put your money in and getting the guaranteed interest earnings and the dividends on your premium dollars, then you've got this credit account, this other pool, this cash value that you can go use to then also, which is a big word, also, especially when it comes to financial products, right? It's not really ever an also, an and.
It's always an either or.
It's always an either or, but now it's an and also. You can also go do those other things. So I'm not even actually telling you like, oh, this is better than going to get 20% somewhere. No, I'm saying you can actually double dip here when you couldn't double dip previously.
Right.
And that's a big deal.
Okay, so double question here is, wait, if I'm taking money out and borrowing, do I need to pay back that money? Do I need to pay back my loans, or should I even pay them back if they're allowing me this cash value to use?
The answer to that question is yes. And the reason the answer is yes is because we teach something very particular. Again, it's called banking. Banking is an action. Right.
Yes.
You ever been down to your local bank and they allowed you to take a loan out and didn't make you sign any paperwork on the way out?
Absolutely not.
Absolutely not. The bank would never do that.
Right.
Why wouldn't they do it?
Because they would not make money.
Exactly.
Because the loans that they give out are going to be assets to them. We got to pay for them. They got to add a little interest charge on them. We got to pay it back. They're going to make money.
Correct. So my follow-up, answer to the question, kind of answering the question with a question is, so how in the world are you starting a banking system but asking me, do I have to pay it back? If you're not paying it back, that's not a banking system you're starting, right?
Correct.
I mean, banks would never. I mean, that's not a question. Have you ever gone to the bank?
Because they would not make profit. They would go out of business.
Oh, this one's cool.
Yeah.
No.
Nope.
They make
non-performing loans are bad things.
Yeah,
you want them to perform for you, and there's a million ways to do that. Right. So don't worry about that. We'll help you with that. We'll hook you up with other folks who can help you.
Right. So we are absolutely going to teach you, and the answer is yes. You've got to pay these loans back. Now, you're not on a set requirement on like how fast you pay them back, or how slow, or how much you pay them back, or how little, or pay it back today or pay it back tomorrow. I mean, that's again, we can walk through those details. You actually get to decide all of those details. But the fact of the matter is, you've got to pay it back. Absolutely. That's how you're going to build your banking system.
Okay, one more big question for you before we close out this episode to help people along their path. This is something you told me. I got a text from you that you got asked this on the phone because you were not having it. And you're like, look, I'm done with some people right now.
All right.
Because
I don't remember.
You got texted and you sent it to me. I screenshotted it. Okay. Somebody asked you. It's not a frequently asked question. You got asked one time.
Okay.
Wait. Hold on. If I get this policy out here, if I get this banking system going, here's my question, Jonah. What if I don't die?
Oh, I do remember this. That's why I sent it to you, because I was like, what? Hate to break it to you. I don't remember who it was. I'm thankful for that. I just let that one rub, in one ear, not the other. But at home and everyone listening in the car, wherever you are, hate to break it to you. You gotta die. You gotta go at some point. It's gonna happen.
Guaranteed.
So, yeah, so I don't remember the point of this question.
Are you our Lord and Savior Jesus Christ? What do you mean? Like, what if you don't die?
Yeah, you gotta go. Sorry.
So they were asking in reference to what? They were asking in reference to the death benefit. Probably. Hey, so all this money, death benefit is guaranteed to pay out, but like, what if I don't die? I guess they thought there was some sort of term on their policy.
Yeah, maybe.
I don't know.
Maybe they just were getting confused, or maybe they were looking at the cash value and thinking, oh man, I really want to make it 20 years to have this cash value. So,
well, if you don't die, 20 years will come and go.
Yeah,
you'll make it.
Get it.
Yeah.
But yeah, that's a funny one.
Maybe they knew something we did not know, and they're
maybe they need to start a podcast. Let me know.
I will be listening to that episode. Here's how not to die. Oh,
3
goodness.
easy steps.
Right. Three meals. Here's the secrets they don't want you to know. Okay, ladies and gentlemen, that comes from the Ranking Bros today. A little bit frequently asked questions coming up in the summer of 2021. We're so thankful that you guys have enjoyed our pieces and want us to give you more. So we're going to do that. We're going to get not just stay on topic to help you save and spend money at the same time and all the banking systems that we teach, but we're going to help you understand now some of the cool things we're even doing in utilizing a cash system through these banking accounts to be able to do all the other things that we want in life. So stay tuned, stick with us, jump into our courses, call us, get a consultation. If you've not yet understood how to get started yourself, we're here for you, and we look forward to serving you in the future.